and welcome to the Of Interest podcast. I'm Gareth Vaughan from interest.co.nz. The Reserve Bank is increasing its war chest for potential interventions in international currency markets. Why is it doing this? How is it doing this? And what can we expect to happen from here? To discuss this and more, I'm joined by Kelly Eckhold, the Chief Economist at Westpac New Zealand. Hi Kelly, welcome to the Of Interest podcast.
Thanks very much, glad to be here.
Look, I thought before we jump into it, it'd be really interesting if you could tell the listeners a little bit about your background, because you've had one particular role that I'm aware of that's very relevant to this conversation when you worked at the Reserve Bank in the past.
Sure, yeah, very happy to. I think I've probably had a few kind of like roles relevant to this. I mean, I've been in the United States for most of the last 11 years. I currently am working for Westpac, but before that I was working in the International Monetary Fund's Money and Capital Markets Department. So through that period, I was working with a lot of different kinds of countries on foreign exchange and central bank kind of like operational issues. Before that, I was at the Reserve Bank for 20 years on and off, and the Bank of England for a couple of years, predominantly working in their financial markets areas. And in particular, I was for a period managing the foreign reserves portfolios there, as well as I had a role in developing the new foreign exchange intervention policy that we're basically talking about today, which a lot of that work was done basically between about 2004 and 2007, there or thereabouts.
Yeah, absolutely. That's really interesting. So I guess if we kick it off with the basics at the beginning of all of this, why does the Reserve Bank hold foreign currency reserves or assets? What's the purpose of them doing this?
Yeah, so I mean, all central banks hold foreign reserves, basically, generally for similar sorts of reasons, but they use those reserves a bit differently. In the case of New Zealand, they've got two main purposes for having the foreign reserves. One is to have a stock of foreign exchange that's available for use in a crisis situation. And that's kind of the main reason why the Reserve Bank here holds FX on average over long periods of time, because you never know when a crisis might erupt, and you can't necessarily guarantee that you can go out and borrow some foreign exchange in the middle of a crisis. And indeed, it's quite possible that you totally won't be able to. New Zealand had that experience during the mid-1980s when there was a bit of a crisis there where we found ourselves caught a bit short. The other reason that they have foreign currency reserves and a foreign currency intervention policy is to assist the conduct of monetary policy. And that's usually more around the idea of looking for those situations where the exchange rate is overshooting either to the upside or the downside relative to where it should be based off its fundamentals. And therefore those situations where when that happens, it usually creates that unnecessary instability in output, inflation, unemployment, all of those other things that are sort of sitting in the Reserve Bank's mandate. So having something in the toolkit there to be able to kind of help manage that is also another purpose for holding reserves.
Okay. And so how and where do they hold these currencies? And it's not just currencies, is it? It's other financial assets as well.
Yeah, so the reserves are generally held in the safest, most liquid instruments available in the most safe jurisdictions that you'll find globally. So on the Reserve Bank's website, they actually lay out what they're kind of like, they call it the strategic asset allocation is for the reserves. And what you'll see there is that the bulk of the reserves are invested in the US markets and in the Eurozone markets. And within the Eurozone markets, really concentrated in those largest, most liquid markets. That's kind of France, Germany, perhaps a little bit of Dutch type sort of like instruments. Obviously the US market is quite a big area, so they've got the US Treasuries market, and they probably have significant holdings in some of the higher rated supranational and US government agency markets as well, the Fannie Mae and the Freddie Mac type securities. So that's probably where most of the portfolio is. But they also do have the ability to allocate some assets into the likes of the Japanese yen, the Canadian dollar, and also sterling as well. And, that group of 5 currencies are the kind of like big reserve currencies out there in the world. They comprise the bulk of the basket that the IMF uses to define reserve currencies. The only one that's really missing is the Chinese renminbi, which the Reserve Bank doesn't hold, and I can understand why, because that currency perhaps isn't fully convertible. But the focus there is basically on safety, liquidity, and then after you've sorted out those two things, the focus then is on returns as well, so that it doesn't cost you too much to hold these things.
Okay. So earlier this year, the Reserve Bank announced that it had agreed with the then Finance Minister, Grant Robertson, a new framework for managing foreign currency reserves. This is known as the new Foreign Reserves Management and Coordination Framework, which was required under the Reserve Bank Act 2021 review that they did. I guess, why do they say that they need this new framework? Why was this sort of put in place?
Well, when I look at the new framework, I see it basically replicates the features of the previous act, but just organises things in a slightly different way. The old act, for example, had different functions that the Reserve Bank could lawfully carry out. Things like, for example, the conduct of monetary policy and crisis market interventions were included in the Act, but they had different protocols about the way that those sorts of functions should be operationalised. When the foreign exchange intervention framework was adjusted in the mid-2000s to fit that set of functions within the existing law, we had a series of memorandums of understanding with the Ministry of Finance, basically governing how those sorts of policies would be operated. What this new framework does is essentially codify that in a separate agreement. And I think probably the main difference between this and the previous act is that the new Reserve Bank law increased the Reserve Bank's role for managing financial stability, and as a result, the financial stability objective is now more explicitly drawn in terms of the use of these foreign reserves and the intervention policy, and all of that's all codified in this framework as well.
Okay, so subsequent to that, we saw a big jump in the RBNZ's foreign currency, I guess, intervention capacity in July of around 4 billion New Zealand dollars, which was done by them selling the New Zealand dollar and building up, I guess, their holdings in other currencies. In the context of the Reserve Bank and the New Zealand dollar, I mean, how big of a deal was this?
So that was a very noticeable shift in the level of foreign reserves. If you, for example, look at the helpful chart that Karen Silk, the Deputy Governor, kind of like put on her speech that she did this week, you could sort of see that since 2008, the total level of foreign reserves hadn't really changed substantively at all through that period. There is a bit of movement up and down in New Zealand dollar terms, principally because the exchange rate has moved up and down through that period. And you should always keep in mind that the level of foreign exchange intervention capacity is generally expressed in foreign currency terms. That makes sense because in the end you're operating in the foreign currency market. But obviously what had happened since 2008 is the economy's moved on. It's around about 80% larger, for example, than it was back then. The foreign exchange markets have also grown quite considerably as well. And as they hadn't really revised the level of foreign reserves since that last major review just before the global financial crisis, it meant that what you got in July was a relatively abrupt movement, which is kind of the start of a move to the new target level of reserves that they're aiming to get.
Yeah, and it's certainly a significant level, and I see that I think that they do those monthly disclosures, obviously, and the last one, the RBNZ had its foreign currency intervention capacity at New Zealand $17.725 billion. So that's come up a little bit further again, hasn't it? The RBNZ say they are transitioning to a higher level of foreign reserves over a number of years, but they won't say what the target level is. What's your thinking in terms of what the ultimate level they might like to reach could be, And how long might it take for them to get there?
Yeah, so to answer that question, I think you probably have to unpack a little bit the different types of foreign reserves that they'll hold on the portfolio. We have this kind of concept of what we call unhedged foreign exchange reserves, and that's where you basically just go and print some New Zealand dollars, sell them for foreign exchange, and then invest them in assets. And that's what happened back in July. You can see that very clearly. That's the 4 billion New Zealand dollars that they sold at the time. But that's probably the riskiest part of the portfolio because you're fully exposed to the movements up and down in the New Zealand dollars after you've done that transaction. It's also the part that's probably the easiest to execute in the short period in the short term, simply because the foreign exchange market is very deep and liquid in normal circumstances. And indeed, when I asked around my colleagues after the Reserve Bank announced that they'd done these transactions, nobody had even been aware that these had been occurring. So they managed to kind of like do these transactions. If you look at the chart of the exchange rate afterwards, you could possibly see some kind of fallback in the exchange rate, but not enough that the markets didn't really notice. So that bit of the job, I think, was done quite quickly in that month. But what remains is this unhedged component, and that's the less riskier part because you don't have an exposure to the New Zealand dollar. Essentially what the Reserve Bank goes out into the foreign exchange swap markets and borrows foreign exchange for a very long period of time. And that means they're really more exposed to interest rate risk rather than exchange rate risk. And interest rate risks are generally an order of magnitude lower than foreign exchange risks. But the trade-off there is that those long-term foreign exchange swap markets are much smaller and less liquid than the spot market. And when the Reserve Bank talks about them taking 2 or 3 years to potentially gravitate to their new level, they're just making a realistic assessment that that's probably the amount of time it would take for them to accumulate that additional portfolio of hedged reserves to get them to where they're going to get to. I would say that it's probably reasonable to assume that the stock of hedged reserves will be much larger than the unhedged ones. And the reason is fairly intuitive in the sense that, firstly, the hedged reserves are less risky. They don't have that kind of big exchange rate risk. They're also a bit cheaper to hold as well, because with the unhedged reserves, where you're selling those New Zealand dollars, buying the foreign currency, you have to pay the interest rate differential on that each and every day. And one of the features about New Zealand is that we tend to have higher interest rates than most of those reserve currencies. When the Reserve Bank goes and borrows foreign exchange in the market to invest in reserve assets, they're still going to pay a bit of a carrying cost associated with that. But because New Zealand is a high-quality borrower, that cost is much smaller. You know, we might be talking in the order of 10, 15 or 20 basis points as opposed to 150 or 200 basis points. So in that way, you could understand that when you do a risk-cost-benefit analysis, it's probably going to mean that all else equal, you would prefer to hold a whole lot more of the hedged ones than the unhedged ones. And I would suggest that if they've done the 4 billion New Zealand dollar equivalent of the unhedged ones, then they could easily do 3 or 4 times that amount in those unhedged markets over the course of the next few years.
Okay, so this could get substantially bigger than the 17 billion it's at now.
That's right, yeah, but I think I would understand that, because if you think about those kind of metrics about what the economy has done since the mid-2000s to now, it has grown by, variously large amounts depending on which metric you want to look at. The foreign exchange market, for example, has probably doubled in size over that period. The economy, as I said, is about 80% larger. I haven't made the calculations for things like the change in the level of imports or exports, but I'm sure all of those indicators will have gone up by a significant amount as well. I would suggest that, when you see that there's a rather large and abrupt change in the level of reserves going on here, it's a consequence of the fact that the framework hasn't been reviewed for a very long time. And I noticed in the new foreign exchange coordination framework, there's a commitment to review more frequently in the future, once every 5 years. And that will mean that we'll get these adjustments occurring in less discrete steps.
Okay. You talked about the Reserve Bank borrowing currency. Who would they be borrowing from?
International markets, basically. Like if you look at the structure of the sort of international FX markets, there's a lot of foreign investors that are big investors in New Zealand. And it's just as well because we've been running a current account deficit for as long as I've been alive and probably longer than most people can remember, to be honest with you. And what that means in practice is that we actually have to borrow a bit as a nation from overseas each and every day to finance the investment that's going on in the economy. There's a lot of willing investors out there that are interested in doing those transactions. New Zealand's viewed as a relatively safe pair of hands in terms of having somewhere to put your money. As I mentioned before, the interest rates can be relatively attractive. The exchange rate is a flexible exchange rate. It's governed by a fairly solid sort of like macro framework. So there's an enormous range of international investors out there looking for good, safe, appropriately yielding investments. And, that's basically where that money comes from.
So the RBNZ says that holding foreign reserves is like insurance against events that might impact on the New Zealand dollar market, and it could intervene for either monetary policy or financial stability reasons. What sort of circumstances might lead to them intervening, and what are the key ways they could do so?
Sure. So the crisis intervention kind of like thing is the probably the easiest one to get your head around. And there the idea is not so much a concern about the level of the exchange rate, even though it's very likely that in a crisis situation the exchange rate will be falling and potentially could be quite low. What's really of concern there is the market open? Is it actually operating in a way that's going to allow price discovery to occur? Is it open to the extent to which New Zealand firms and investors can manage their foreign exchange risks and allocate foreign exchange risks? Because if it's the case that the market is closed, then firstly, you'll probably have very little idea about where the exchange rate actually is, but it won't be very long before you actually can't do the sorts of things you need to be able to do. For example, buy imports, for example, right? And if I go back to my time in the International Monetary Fund, I worked in a lot of emerging market countries that actually often had that exact problem, where their foreign exchange market was sufficiently dysfunctional that there would be queues outside banks to get foreign exchange so you could go overseas or buy something that you wanted to buy. We never have those problems in New Zealand because we have a well-functioning foreign exchange market. The purpose of having the intervention policy for crisis situations is to keep it that way at all times, because what tends to happen in situations where the market becomes dysfunctional in a crisis is it just compounds on the already significant economic problems that are existing in the economy, which has given rise to the crisis in the first place. So I think there the focus is not really about the level of the exchange rate. Is it operating? Can you find a price? Can you do a transaction if you need to be able to do it? Will banks be prepared to quote customers or not? Are the sort of key metrics there. And I would suggest that every central bank in the world would have that as a core part of the reason why you have a central bank. There's nothing particularly exceptional there. The monetary policy intervention aspect is a little bit different. And what that is really thinking about is that when the exchange rate overshoots or undershoots relative to its justified or fundamental levels, that in itself can create those challenges for monetary policy. Because when the exchange rate gets very misaligned, you get adjustments in the allocation of resources around the economy, and you can potentially get that undesirable instability in employment and output, potentially in inflation if you think about it through the cycle. Because what tends to go up goes down, for example. Exchange rate gets really overvalued, you get lower inflation for a while, but then when it corrects, inflation goes back up again, so you get a lot of volatility. That's generally seen as really undesirable. And one of the reasons why the Reserve Bank incorporated monetary policy intervention into the toolkit was to have a tool basically available to try to lean against some of those really large unjustified deviations of the exchange rate from what they thought would be reasonable given the fundamentals. In that case, like I think there's a recognition at the Reserve Bank that the Reserve Bank would have a very limited ability to change the level of the exchange rate in the short term. They're really leaning against the wind to try to attenuate a little bit the size of the cycle as opposed to necessarily fix the exchange rate. I mean, that's kind of the objective that's going on there. And they've got a whole set of criteria that they use. Firstly, to try to identify whether the exchange rate is actually misaligned from fundamentals or not. And then particularly, is the market in a situation where you actually might be able to effectively use what is probably a relatively weak tool to good effect without giving rise to too much risk? How would they do intervention? Well, the main exchange rate pair that you would do intervention in any currency would be versus the US dollar. So whilst there's a lot of people doing lots of transactions in lots of different currencies, they generally all start with a transaction of the New Zealand dollar against the US dollar. And then at that point, once you've got your US dollars, you can do a transaction to any other currency in the world. But that's in the US foreign exchange market, not in the New Zealand one. So that in itself is a bit mechanical. It would probably have a very similar sort of like operational kind of like role, whether you're in a crisis or in a monetary policy situation. Increasingly, those foreign exchange markets are electronically traded now. So in the old days, you might ring up a dealer and do a transaction. I suspect now you wouldn't. You would probably go into a computer system and start loading transactions into banks and then having those transactions occur. The other difference between those two modes of intervention is maybe the degree of publicity that you might have around those transactions. In a crisis situation, you may choose to be relatively public to try to calm markets. In a leaning against the wind situation, you may choose to do that as well, because if you make a big announcement, then you potentially can use your announcement effect to help improve your chances of success. Or you may also not do that as well. You may be just looking to kind of like more quietly influence the foreign exchange rate. And central banks do both of those sorts of activities in different circumstances.
Absolutely. So, I mean, the Reserve Bank has obviously intervened in the past either to weaken or strengthen, with the intention of weakening or strengthening the New Zealand dollar. I can think of a few occasions when that's happened. What's their record like on currency intervention? And I mean, interesting point you make there that they sometimes announce it, sometimes they don't. So presumably we aren't aware of every time they've done it, although probably it mostly comes out, I would think, eventually.
So on the crisis intervention, there's never been any crisis intervention that has occurred. I can remember one situation back in 1999 or early 2000 when the exchange rate got down towards 39 cents against the US dollar, where perhaps things were getting sufficiently dicey where that might have been a consideration. But we haven't, thankfully, been in a position where that's really had to happen. There has been kind of one other major intervention episode since the new regime was put in place, and that was immediately before the global financial crisis, where the exchange rate became quite overvalued. You may recall through 2007 that happened, and the Reserve Bank did its first intervention quite publicly, issued press releases at the time, explained what they were doing. They judged that the exchange rate was overvalued and unhelpful from a monetary policy perspective, and sold a reasonable volume of New Zealand dollars, about 1.5–2 billion New Zealand dollars at the time, at a relatively high exchange rate as it transpired, and then they managed to cover that position back later on when the global financial crisis came, and you may remember that the New Zealand dollar fell very significantly through that period. After then, I don't see actually very many other episodes of leaning against the wind in either direction. There appears to have been another episode while I was working overseas around 2014 where they did
I recall that. Yes.
You can see that in the chart there, and then I can see a period later on where the exchange rate corrected back a little bit so that they squared that position up. What I would be if you look at the chart, it looks like they've probably done fairly well out of all of these things. I certainly remember from the 2007-8 episode that was very successful. Quite a substantial dividend was paid to the government through that period. If I remember correctly, it was $800 million in 2009 or something like that. That's all public record. But the thing about this is that you always know what they've done after they've done it. That's why they have these tables on the website. There's nothing particularly secret there. Not all central banks do that, but the Reserve Bank does have that commitment to transparency. It's in that coordination framework. It requires that transparency. And I would argue it's actually quite critical because, from the public's perspective, we need to be confident that the Reserve Bank is doing what they're supposed to be doing and they're making good use of government resources, public resources.
Yep. And I mean, through this new Foreign Reserves Management and Coordination Framework, as they're calling it, we shouldn't expect that this means they're going to be more active, should we?
No, I don't think this implies this at all. I think the new framework essentially just codifies in a slightly different way what was put in place a long time ago. The level of reserves has been adjusted because of the passage of time, I think. There was a capital injection given to the Reserve Bank to reflect the fact that if they were going to hold a lot more reserves, there was going to be some more risk on the balance sheet associated with doing that. The reason I think that we saw the sudden move to accumulate the reserves in July, it was coincided pretty closely with when they received that capital injection. They obviously took a judgment at the time that it was better for them to just quickly do what they needed to do as opposed to wait. It's always a bit of a hairy hindsight situation here. I mean, if we look at when they did those transactions, it looks like it was probably the best exchange rate that we've seen in the last 6 or 9 months. Who knows if it'll be the best exchange rate they could have had if we wait another year. We'll see what happens. I suspect they're probably on the right side of this one, but you don't know. Other central banks have taken different approaches. I remember the Central Bank of Israel about 7 or 8 years ago similarly decided to accumulate more reserves for a similar purpose. And what they did was just pre-announced. They said that we're going to take a year or so to build up this portfolio. We're going to do an even amount every week or month. And their idea was that if everybody knows that, then it was not going to have an exchange rate impact. Reserve Bank chose instead to just do it in July. I think that there are probably reasonable arguments for both perspectives.
Yep. You mentioned the capital. So the Reserve Bank received a $500 million Crown capital boost. There's also a Crown indemnity of an unspecified value that I actually asked them about this week, but it's commercially sensitive, I think, is the words I was told. So that they're not going to tell us what that is, which isn't surprising, I guess. But as a journalist, you always ask. So I mean, that does sort of lead to the question though of just how risky is what they're doing here. In terms of the potential impact and scale of it.
Yeah, I mean, and the reality is that trading in foreign exchange markets is inherently very risky because exchange rates are extremely variable. It's, not uncommon for the New Zealand dollar to vary 20 or 30% relative to its long-term average over a cycle. And when you're a central bank holding foreign reserves, you're fully exposed to all of those changes, right? So the good news is that generally it is a cycle. So the ups get replaced with the downs through the cycle so that in general the Reserve Bank ends up no better or worse off if they just hold the reserves. You could also argue that the biggest financial risk from holding reserves is if the New Zealand dollar appreciates, because that's where your foreign currency is going to be worth less New Zealand dollars over time. basically. But if you think about the sorts of situations in which the New Zealand dollar might trend appreciate, it's probably because something quite good has happened to the New Zealand economy. So to some extent, you can probably think of what the Reserve Bank has here as a bit of a natural hedge, in the sense that, okay, if something really good has happened to the economy, let me think of, we strike some oil, we find some gold, we suddenly get a lot more productive, exchange rate goes up. Well, all of these things are going to also mean the government's tax revenues and the value of the government balance sheet is increasing, probably by a heck of a lot more than this amount of foreign reserves, because it's pretty modest in the broad scheme of things. I think I calculated the total government's foreign exchange reserves yesterday at about 7% GDP, if I remember correctly. So we're not talking about something that's going to break the bank here. There's probably a bit more risk in the bit where you are taking the tops and bottoms off of the cycle, because you're probably not going to end up doing all of your intervention at the best possible exchange rate that you could have possibly done. So there will be the potential to see yourself out of the money, at least for periods of time when you're doing that. In crisis intervention, there could be some risk there, but in a crisis, what typically will be happening is your exchange rate will be falling quite rapidly. It'll probably be very uncertain about what the fundamental value of the exchange rate is going to be, probably because something quite bad is going on in the economy at the same time. And in reality, it may well be that the Reserve Bank would lose a bit by doing those sorts of activities. But the economy would also be gaining there, because people would actually still have a foreign exchange market that was open. Probably it would be the case that financial conditions wouldn't tighten by as much as would otherwise happen when the exchange rate suddenly depreciates and the foreign exchange market starts to break down. Now, a real problem that emerging market countries have when they have an FX crisis is that usually, we often think of like a lower exchange rate as something quite good for our export sector, but for a lot of countries, when that happens, it actually results in real hardship for the economy.
Yeah, we've certainly seen that around the world many times. So look, Kelly, just finally, what impact, if any, does all this have, or could this have on exporters, importers, and people who travel overseas regularly? I guess people who are very interested for obvious reasons in the value of the New Zealand dollar.
Well, I think with respect to the crisis intervention role, what it really does is help provide a bit of an insurance in the event that some relatively rare but bad situations occur. And one of the good things about insurance is that it makes probably people a little bit more comfortable investing in the country, because they feel that there's some buffers there that could be used if something bad happens. That probably means all else equal, your interest rate's a little bit lower. Potentially your exchange rate could be a little bit less volatile, and that's going to be to the benefit for all of those kind of like ordinary New Zealanders and firms that you're talking about there. For the monetary policy intervention operation, to the extent to which they have some success in helping moderate the cycle, then that would help contribute to reduced instability in output, inflation, the exchange rate itself. And that's going to also be a benefit to everybody over time. You don't get a free lunch here. The cost of the lunch is the insurance premium, those interest rate differentials I was talking about earlier, and also the fact that potentially for periods of time you may be out of the money a little bit, and you'll be looking at the Reserve Bank's balance sheet going, there's a mark-to-market loss here that may be there for a period of time.
Well, look, Kelly, thanks so much for that. It's a really interesting topic, I think. We're always interested in what's going on with the New Zealand dollar and what might happen to it. That's Kelly Eckhold, Chief Economist at Westpac New Zealand. And I'm Gareth Vaughan with another episode of our interest.co.nz of Interest podcast.